Okay, welcome back to the part B of accounting for bond payable. So first of all, we wanted to learn how to record a bond. That how when they're issuing a bond and what we do in the related journal entry, right? So let's look at an example. So let's assume that a bond issue for California Color Coaster issued $100,000 of a bond paying 7% interest of $100,000. So here I wanted to emphasize its borrowing amount for the issue for $100,000 of a bond, meaning the face value of the bond is $100,000, and then they are asking for 7% interest accumulating on the $100,000 of borrowed amount. For this is a very key word, meaning that this bond, this financing instrument sold to the investor for $100,000. And so, in another word, is that it's sold at its face value, face amount. Face is what is written on the bond contract, $100,000. And when you sold this bond for $100,000, we call it sold at face value. Okay. And how do we record this transaction? First of all, of course, we will debit cash because people are gonna deposit cash into your bank if this is a successful transaction. And then credit, you are the one borrowing money from people, hence that your credit are payable, or the bond payable for $100,000. And then first semi-annual interest payment, no fuss. It's just a recording 7% dividing 2 for the carrying value outstanding, which is $100,000. So you will get $3,500, right? And then you debit the interest expense and cash, credit cash. Okay. So now that's why I wanted to introduce you what is the difference between stated interest rate, which is the interest rate promised on the instrument financing or bond contract, 7%. Okay, and what is the face value? Face value is the instrument stated borrowing amount, and then there's a difference between the stated interest rate versus the market rate. The stated interest rate is specified in the bond contract, and market rate is not specified in the bond contract. Investors demand a higher market rate for bonds that have a higher default risk. As the default risk of a bond increases, investors can increase their rate of return over the life of the bond by paying a low price at the issuance date. In other words, all else equal, right? So market. So first of all, market rate is not stated in the bond contract. Market rate is an implied rate based on the price investor pay to purchase a bond in return for the right to receive the face value at the maturity and a periodic interest payment over the remaining life of the bond, right? So in other words, that this is the real rate that people willing to loan you money at. Okay, regardless what you say, you're gonna pay them at the stated interest rate. And all else equal, investors always demanding a higher market rate for bonds that have a higher default risks. And the default risk, first of all, what is default risk? Default risk meant that refers to possibility that a company will unable to pay the bond face amount or interest payment and they become due, such as this company may have not a stable operation, right? Or the market is too competitive, and when the debt is due or interest amount payment is due, they are not able to pay. Hence, this kind of firm has a high default risks. Okay, and so when the default risk is high for this company, the investors is also take a higher risks to invest in this kind of a company. Therefore, high risk, high reward. High risk investment requiring higher rate of return. So if the bond at this time, if the bond is stated at the stated interest rate, right, is less is less than the market rate, then the bond has to be issued below face value, which is a discount, right? The reason is that investors want to increasing their rate of return over the life of the bond, right? Because the offering rate is lower than the market rate, meaning that the real rate that the investor really looking for, say it's 8%, okay, in this case. Because this company is really risky, hence that they still want to, the investors still want to loan money to this company because they feel like higher risk, higher return. So the real rate or market rate of this bond is at 8%, but you only promise the investors to only pay them 7%. Therefore, the higher default risk motivate investors to increase their rate of return over the life of the bond, right? Hence, how do we do that? In order to do that, you are gonna willing to accept less payment at the issuance date, which we call it issue the bond at a discount, meaning that the buyer is not gonna pay you $100,000 what you are asking for. They're only gonna pay you $93,000, right? And then you got to pay them 7% at $100,000 for next 48 months of next 20 years. Because you are very risky, you are likely to default, and they like to invest in you, but they wanted a higher return than what you promised. And then if that's the scenario, that means that investors is not gonna pay you $100,000 like you asked. They're gonna only pay you $93,000 at the issuance date. And that way, over the life of this bond, they can earn higher interest. And in this scenario, we call the bond is issued at discount. Okay? And a bond can be issued at face value, or it can issued at discount or premium. When we talk about premium, I can give you a scenario as well. Okay. Okay. So let's look at this discount case. If a bond is issued at a discount, then issue $100,000 bond at 7%. Hence, on the contract, you borrowed $100,000 and promised to pay 7% semi-annually, right? And then you know that the market rate for similar risk you are promising to give is actually 8%. In other words, if the company look like you, and usually they will have to offer 8% to satisfy the investors, and that's the market rate. Okay. So the difference between the bond payable, so therefore you can only get paid $93,205 at the issuance date. So you are asking me, what do we do with this difference between the stated value or face value and the initial cash payment? This difference we can park under account called discount on bond payable. First, you will debit cash of $93,000 and then credit bond payable at the face value, because at the end of the day, you're still going to pay $100,000 when the bond is mature. And the difference between what they give to you as cash and what you will pay in the future as bond payable is called a discount on bond payable, and it usually have a debit side balance. Okay, let's write this down, and then you have a discount of $6,795. Okay? So we call this bond issue at a discount. And then if you present it on the balance sheet, you're still under the long-term liability section, and you put the bond payable at the stated amount face value. And then you will put a discount on bond payable of $6,795 to tell the investors that your carrying value of this bond is only $93,205. And the common mistake the students sometimes make is that they record interest expense using stated rate rather than the market rate. In other words, when you're calculating the interest expense, for this bond payable, you need to use the real rate, which is market rate, multiple the carrying value of the bond. Okay, and remember that interest expense is the carrying value, okay, times the market rate, while the cash payment, which is the when you pay in the cash, when you each time you pay in cash payment will be the stated rate multiple the face value. However, the interest expense, right, is gonna be the market rate multiple the carrying value, the real value of the bond. Okay, we will talk about details. Okay, for example, in this section, we want to show you the amortization schedule of a bond issued at a discount, right? So at the beginning, you was promising for 100, you issued a bond at $100,000, and you promised the same paying 7% a year, and the similar risk entity actually can offer 8%, or market rate of similar company actually offer 8%, and that you issued at a discount. And in exchanging for this note, you only get paid $93,205. Okay, that's your carrying value of the bond. And the interest expenses is always gonna be equals to carrying value, which is $93,205 multiple 8 dividing 2, right? So for 10 years, right? And then this one is always gonna be equal to 100,000 multiple 7% dividing 2, because it's a semi-annually. So as you can see, the interest expenses is much higher than the cash paid, right? And this difference, if we use the third column minus the second column, this difference is going to be a value to increase face value. So in other words, this number equals the carrying value for $93,205, adding $228, and then your carrying value is increasing for $228. Similarly, another half year later, which is December 31st, you use your carrying value of June, end of June, multiple 4%, right? So which is this equals to 33,733. 7 is equals to 93,433 multiple 4%, right? Then you got this number. And at the same time, your cash payment is always the same, which is still equal to $100,000 multiple 7% dividing 2. And the difference between these two, we call it amortization on the discount. So therefore, the difference is the $237 is going to be added to this number, and then to increase in carrying value from 93,433 to 93,670. Okay, and going on for 20 period, because you borrowed for 10 years and you pay twice a year, right? So you're calculating this table for 20 times. At the end of December 31st, 2030, the end of the loan. And then you will find that your interest cash payment is still $3,500, and your interest expense is really high, right? The last interest expense is the highest of all. It's because the previous carrying amount grew to $99,519. It's increasing, right? And then the difference between the interest expense minus the cash paid, this is called the amortization of discount, is adding back to 99,519, and then you got the ending carrying value of the note become 100,000, which equals your promised your rate your stated face value of the note. So in summary, because you promised to the rate of return of your bond is less than the market rate of return for that similar default risk company. So you wanted to ensure that the investors enjoy higher rate of return over the period of this bond, right? Otherwise, why they are buying the bond at 7%? Therefore, you have to issue the bond at a discount. By issuing the bond at a discount, it means that over the life of the bond, your interest expense is growing. At the same time, your face value or your carrying value of the bond is increasing. And the increasing too equals to the stated the face value of $100,000. That's at the last period. It's grow back $100,000 to the stated face amount. From the discounted value, grow back to the stated value of $100,000. Okay. So let's look at the journal entries. So how do we record this kind of journal entry? First of all, we want debit. First of all, same thing. We wanted to make sure first that we debit interest expenses, which is the carry value multiple market rate dividing 2 annually, and we credit the cash payment. Cash payment always equals to the face value multiple stated interest rate dividing 2. And the difference between these two is parked as credit side, right? Because the debit side is the 3,728 and the credit side is the 3,500. Hence, the credit side is short. Therefore, we will amortize the discount. Remember, we said discount on the bond usually have a credit side balance, right? At the beginning, you have a credit side balance of, let's see, the previous. You have a credit side. You have a debit side balance of $6,795, right? So this is debit side. And across the time, 6,795. This is the issuance date, right? Initiation date. And then the first period, you have a credit side of a discount of $228. Okay, so therefore, as you can see, the amortization of discount is to amortize the debit side balance of discount over 20 period until it's exhausted to 0. Okay, so 20 periods later, this discount on the bond account will have a 0 balance. Okay, so therefore, just remember the first period, you religiously debit the interest expenses using carrying value multiple the market rate. Okay, and at the same time, your cash payment equals the promised the face value multiple the stated rate, and the difference you will park on the credit side of discount on bond payable. And if you put into a T account, you will see the initiation of the discount on the bond is on debit side, and each period is crediting a piece out of it, right? Okay, so the second semi-annual interest payment is the same thing. Debit the interest expense. The carrying value is grow from 93,205 grow $200 more, and then multiple 8%, it becomes 3,737. At the same time, you will pay cash as a stated amount of 3,500, and then you will credit discount on bond payable for 237 or second period, right? So go on and forth for 20 period, you will find a discount of bond will exhausted to 0. Okay, so this is what we said about the bond issued at a premium. What if now assume that the California Coaster issue a $100,000 at 7% bond when other bonds of the similar risk are paying a market rate only at 6%? Okay, So that means that you are promised to pay a lot more than similar level of risk other entities paying. So this bond, we said in these scenarios, this bond needs to be issued at a premium, okay, and at a premium of $107,439. So investors, why is that? Because investors will pay more than $100,000 for this 7% bond, because the bond of similar risk are only paying at 6%, but you are promising at 7%. And when bond issued at more than face value, we are saying that this bond is issued at a premium, and California Coastal record bond issuance as showing as here. So if you are recording a debit side of $107,439, and you credit the bond payable only $100,000, right? And then you will have a credit balance, extra credit balance you will park under account name called premium on bond payable. And this let's write a G account called premium on bond payable, and we put it down $7,439, right? And then on the balance sheet presentation, it's still under the same section called long-term liability. Instead of less the discount, this time we put add premium on the bond payable. Hence, the carrying value is actually higher than the maturity value. It's at $107,439. So let's look at the amortization table of this premium bond. Similarly, the cash payment always uses base amount for the stated rate, and the interest expenses is always recorded at the carrying value and multiple market rate. As we remember, right, prior carrying value before the initiation on January 1st is actually higher than $100,000, which is $107,439. If you multiply the market rate at 6%, you are getting 3,223. So it's specifically written 107,439 multiple 6% and dividing 2. You will get this number. And the face amount multiple stated rate is $100,000 multiple 7% dividing 2 equals 3,500. And the difference between the interest expenses and the cash paid is cash paid is much higher than the interest expense, and this difference is gonna be amortized the premium carrying value, which means that you will use 107,000 minus $277 to get the carrying value. In other words, when your cash paid is much higher than the interest incurred, the actual cash paid is wearing out the carrying value issued at a premium. It's reducing the carrying value at the premium. It means that you are giving back towards the investors. Okay, so half year later, same thing. Your cash payment is still $3,500, but your carrying value is reduced from $107,439 to $107,162. Hence, that your interest expenses, similar value of similar risk of other company, you will only pay interest expenses for $3,215. But because this note promised to pay the $3,500, right? This difference will amortize the premium carried by this note. So therefore, you will use 107,162 minus the 285 to give back towards the investor who paid much higher than $100,000 at the beginning. Okay? Therefore, the carrying value is reduced to $106,877. So, in nutshell, is that when your note is issued at $100,000, which is a face value you are payable at the end at 7%, which is higher than the market rate that similar risk companies promise to pay. people wanted to buy this bond at much higher rate than what you're asking for. People want to buy this because you promised them to pay them higher than the market. Hence, when they give you the money at the beginning, they'll give you much higher than what you ask. They give you they will give you $107,000, right? $439, $7,439 more than what you ask. But during the period, based on this payment arrangement, every $3,500 you paid, you find out that payment amount is much higher than the real interest rates generating by this note. Therefore, the difference is sort of giving back gradually what was original higher payment. So every first time you paid for 277 extra, and the second period you paid for the 285 extra, and at the same time this extra is reducing the carrying value of the notes. At the end, which is the 20 period later, 20 payments later, your carrying value will reduce towards the promise, the face value of $100,000, and your interest expenses still decreasing. In other words, when you issue your bond at a premium, your carrying value and interest are continually decreased. If you remember, in the premium, in the discount example, your carrying value and your interest expense is continuously increasing, right? So that's a big difference between bond issue at a premium versus issue at discount. So let's look at the journal entry. How do we journal those interest expenses and interest payment during the life of the bond? So first assignment annually interest payment when bond issue at a premium, we wanted to debit interest expenses, of course, a carrying value multiple the market rate, right? And then we have a 3,223 interest expenses, but the installment payment of the cash is actually promised higher, right? Was 3,500. So the difference we wanted to be debit on the premium bond payable. So if we draw the account, so bond payable, premium bond payable, it's actually originally have a credit side balance of $7,439, and then first period we take 227 out of on the debit side, right? Okay, the second semi-annually interest payment, of course, first of all we want to reduce the carrying value, right? The difference, the amortization of the premium bond of $227 gonna reduce the carrying value of $107,439 for $277. The interest expenses is gonna be less than last period. The interest expense is gonna be $3,215, and the cash payment is still gonna stay the same of $3,500 credit cash. And you're going to debit the difference, you're going to debit on the premium on bond payable for $285. Hence, the second period, you reduce the premium on bond payable from the debit side. Think about a 20 period later, this account is going to have a zero balance at the end. Okay, so if we draw a graph about changing of the carrying value over time, comparing issue at the face value and the issue at a premium and the issue at discount, you will see a very interesting graph. So issuing date, if we are issued at 100,000, that means we are issued at par or issued at face value. If we got paid 93,205, we are issued at discount. If we are paid by 107,439 because our note when the stated rate is higher than the market rate, we are issued at a premium. When the stated rate is less than market rate, we are issued at discount. When the stated rate equals market rate, we are issued at face value. So across the whole life of the bond before we enter in the maturity date. As you can see, three methods, they always at the end of the period, the maturity date, the carrying value has to become 100,000. Hence, the premium have a gradually decreasing carrying value, and the bond issued at the discounted increasing the face value. For a bond issued at a discount, the carrying value increasing over time. For a bond issued at a premium, the carrying value decreasing over time. Both we call it premium amortization, and discount we call it discount amortization. So the key takeaway from this is that when bond issued at the face value, the carrying value and the corresponding interest expenses remain constant over the time. When the bond issued at a discount or below the face value, the carrying value and the corresponding interest expense increase over the time. When a bond issued at a premium above the face value, the carrying value of corresponding interest is decreasing over the time. Okay, so this is going to be a great multiple choices, right? So if I ask you, when is the bond issue at a discount, and how did the trend of the carrying value, is it increasing or decreasing? So this is important to remember. Let's see, for a 10-year bond, it is issued with stated rate of 9%, and when the market is 8%, the bond will be issued at, so of course, a premium, right? Because the stated rate is higher than the market rate, hence the bond is issued at a premium. Okay, so we talk about the life of the bond. Hence now, if we are at the end of the life of the bond, how do we retire the bond? So retirement of bond usually have two kinds. Bond retire at the maturity, bond retire before maturity. So companies buyback usually first of all, retirement can be retired at the maturity. It means that the carrying value equals to the face value, meaning that you are holding the bond as long as the promised contract promised the time. The bond is payable by debit. So remember, at the end of the 20 period, the last journal entry will be debit bond payable for 100,000 and credit cash for 100,000, right? So that's the day that you're gonna pay back the whole principal amount. So that means that the bonds are retired at maturity. But at the same time, bond can be retired before maturity by exercising a call feature. Remember, bond have a different feature: collateral, secure, non-secure, term bond, serial bond, convertible bond, callable bond. So when you have a bond that has a call feature or callable bond, including in a bond contract, you can buy back your bond from you can buy back a bond at the fixed rate that it's in the contract, negotiated in the contract. Otherwise, you can buy back the bond in the more open market. And second of all, retirement before maturity, we can call it early extinguishment of the debt, and it may result a gain or loss equal to the difference between the book value and the of the bond and the price paid by retirement bond. So this is nothing difficult than the ones we learned in the long-term asset. Remember, long-term asset also can be retired early. You don't need always to use to the exhaustion of the residual value. So same thing, if you are buying back the bond, if the payment that you're willing to pay to retire the bond early is higher than the carrying value of the or book value of the bond, then that means that you are recording a loss. If you're buying, extinguish the bond or paying payments, the cash payment before maturity is less than the carrying value of the bond. That means you are retiring a bond at a gain. Let's look at this specific example. So bond retirement occurs when it's issuing of corporation buy back its bond from the investors. So assuming that 100,000 in bonds are retired at maturity at December 31st, 2030, so we will debit. So this is at maturity, right? Example. So we'll debit bond payable and credit cash for $100,000 at whatever that the bond carrying value, right? At maturity, it was $100,000. And then no gain or loss involved in this transaction. Let's assume that when bond retirement before maturity, for example, California Coasters issued bonds on January 1st, 2021 above face value at a premium of $107,439 and a carrying value of the bond 1 year later on December 31st, 2021 become reduced. Remember, issue at a premium, the carrying value always decreasing. So 1 year later, the carrying value become only $106,877. So record the bond retirement before maturity, and then this company paid $114,000 to retire this bond. So how do we record that? First of all, we wanted to reduce amount balance to zero. Remember, when we retire asset, we wanted to credit the asset, right? And also we will debit the accumulated depreciation associated with that asset. Same idea. If a bond is issued a premium, so the bond payable is recorded at 100,000. At the same time, the premium on bond payable is like a sister, is a stick together. These two always exist. So they are together. Hence, when you want to retire them, you got to remember to debit both accounts. Okay, debit the premium on bond payable for $6,877. That's how you get rid of this account of your book because you're retiring. At the same time, you credit the cash amount of $114,353. So the difference is gonna be recorded as loss, right? Because you are paying much higher than the book value of the bond. So the difference is $7,476 is gonna be recorded as loss. So California record a loss for the difference between the price paid to repurchase a bond. They paid $114,000 and the bond carrying value at $106,000. Okay, then you might ask us like why we buy back the debt early. So there's three related issues. First of all, when interest rates decreases, companies with a call feature are more likely to repurchase a higher cost debt and then reissue the debt anew at a lower interest rate, right? Because when you promise someone paying at 7% and you find the market rate is only 6%, so your borrowing cost is actually decreasing. However, you get hooked into this bond and you cannot get out. Therefore, you definitely wanted to, buy back this whole bond and then reissue it at a lower cost. That we are saving money, right? This type of buyback and reissuance lower the future interest expenses for the company, right? Second scenario is that you can to repay the debt early is to improve the company's debt to equity ratio. If your debt to equity ratio is too high, that's you are carrying too much risks. Hence, that's less likely for you to borrow money at a cheaper rate, right? Because you already borrowed so much to extend if you wanted to expand your firm by borrowing more debt, and then bank evaluating your debt to equity ratio is already say 70% to 80%, and it's running a very high risks of default. Hence, it's less likely to get new financing opportunity. So that's another reason that if you wanted to adjusting this rate to lower, that's why you wanted to retire your debt early. And the third reason is that the early extinguish of the debt can also be timed by the management to managing report earning. It's another way we call the earning management. And since the bond payable are reported at a carrying value, not market value, firms can time their repurchase of bond to help to meet the earning expectations. For example, when the interest rate goes up, the bond price goes down. Hence, that in this case, a company will report a gain rather than loss on early extinguishment, right? So when the bond carrying value is decreasing, and you are easily to find that you can get the payment, the promised payment, retirement amount, say, so for example, the carrying value originally become reduced to $80,000, and then the payment is actually $70,000 because the bond price become cheaper because the interest goes up. Therefore, you retire this bond by only pay $70,000 rather than $80,000. Hence, that you report a gain, right? And then you'll ask me, why is the bond become cheaper when the interest rate become increased? Because when the interest rate increases, investors are more likely to not want to. Investors are more likely to save, right? Or they are more likely to invest in other people who can promise a higher rate than you. Hence, that your bond become less valuable, become cheaper. So exactly same analogy like the issuance at a discount. Hence, that when your bond is actually become cheaper because the market rate is increasing, then you can retire your bond at a much cheaper rate. When you retire your bond at a cheaper rate, cheaper amount, that means you can actually generate gain. Okay, so the key point we want to take away is no gain or loss is recorded on bond retired at maturity. For bond retired before maturity, we call it either a gain or loss on the early extinguishment, equal to the difference between the price paid to repurchase the bond and the bond carrying value. Okay, so we talk about the part B, and then in part C, we wanted to talk about how do we pricing the bond. Where did you get that $93,048, right? How did you calculating that? That should be the initiation value of a discounted bond. How did you know I have to pay $107,400 at a premium for bonds actually issued at $100,000, right? So how did you get this number? How do we price a bond? Okay, next video we're gonna talk about it.